In this webinar series, we will discuss the know-hows of fundamental analysis. Let's begin. So we will take a look at the economic calendar and also some very important, relevant key data that does have an effect or leads to sharp movements on the products that you guys are trading. So first, let's identify what is fundamental analysis. It is the process of producing price movement forecasts based on or by examining the underlying economical data and its correlation with the economical cycle. Traders should consider this because it definitely has a large impact on products' direction and price action due to changes in interest rates, employment data, GDP numbers, international trade, manufacturing data, and so on. They also affect at height the national currency as well. So if we have data from the US, we're going to see the dollar experiencing some intense volatility. And if we have some data from the UK, we're going to see the GBP experience some intense volatility. It will also affect cross pairs and major indices and stock prices as well globally. The end goal here is to locate a trading opportunity and compare the current price with the price after the data is released. The economic cycle. It's important to know where we stand in the economic cycle and where we are with the trend. Obviously, after the COVID-19, we experienced a low, then we experienced a peak, and the peak took major indices really high and surged, and we saw a surge in almost all the assets, but we were led to understand that we will experience a low due to the economic cycle because stock markets are literally just like a reflection of the economy. So right now we are facing recession concerns due to the sharp interest rate movements that we're seeing from central banks around the world to curb inflation. And this is why it's important to also identify where we are at in the economic cycle. So right now we're seeing high inflation, but we're tackling it by increasing interest rates. Therefore, we may experience in the medium term or even in the short term a recession or a really high intense slowdown in the economy due to the pace or the path that we're having right now. So let's take a look at the economic calendar. This is Forex Factory economic calendar, and it's essentially a timeline of upcoming economic and political events that serve as indicators to measure the performance of a particular or entire sector of the economy. Since these results indicate how successful the market sector or economy is, traders use this information to help them determine the way the market or a particular asset or product will move. This will help shape their investment decisions. Let's begin with one of the most important economic indicators on the economic calendar. This is the PMI, Purchasing Managers Index. In the US, one of the most closely watched economic indicators is the Institute for Supply Management, PMI, or PMI for short. And it kind of gives us an overall picture of the confidence of businesses within the economy and help determine whether they show expansion or contraction. Gross domestic product is also a key reflection of the health of the economy, and it represents the total market value of all goods and services produced in a country during a given year. So obviously, if there was a halt in production, this will lower the GDP number because then we were going to be facing lower export numbers and so on and so forth. So GDP number is a good reflection of the health of the economy because it has a lot of added justifications as to why the economy is doing well or it's not doing well. So the information gathered can be used to predict the overall confidence of the businesses, again, to show expansion or contraction. Purchasing Price Index. One of the reasons why PMI is one of the most followed economic indicators is its strong correlation with GDP being one of the first economic indicators to be released monthly. The GDP component is that the PMI is closely linked to as an investment component as well. Readings above 50.0 indicate expansion and readings below 50.0 indicate contraction. So any numbers between 50 and below 49.0 X and 48 point X, it's still experiencing a contraction, even though it can be higher than the previous or higher than the expected figure, but it's still not as stable. So economy is facing any indicators above 50, like the flash services sector or the manufacturing sector. It means above 50, it means that the economy is stable and doing well on the manufacturing side or the services side, etc. Consumer price index is another inflation figure. It is not directly related to GDP, but it's a leading indicator for to understand the significant impact on a company's performance and assets. So it's basically a basket of goods that you try to understand whether the price like the price hikes or the let's say prices have risen. So according to this basket of goods by consumers, if it stays the same, then relatively the CPI is stable. However, if it keeps increasing, that means that inflation keeps increasing, and the basket of goods you will see that consumers are taking less things on the basket, and that means that CPI is relevantly going up. So to measure inflation, the CPI is one of the most closely watched indicators, and it measures the change in prices of a basket of commodities relative to the base year. Retail sales and industrial production are also two very important key figures. The retail sales report measures the total receipts of all retail stores in a given country, and this measurement is derived from a diverse sample of retail stores across the country, and it's particularly useful as an indicator of economic performance. All these indicators are a reflection of how well the economy is doing. So if retail sales is higher, then that means that there is consumer confidence, it means that there's consumer spending, and that means that there is going to be a lot of demand to meet the given supply. Industrial production is on the production side, and it shows a change in the production of factories, mines, and facilities within the country, ideal for a country to see an increase in production while at a maximum benefit. The non-farm payroll data is really, really important. It consists of three main elements: the average hourly salary, the change in NFP, and unemployment rate. It shows the total number of wage workers in the US minus farm employees. So it's non-farm payroll data, and also minus it's government employees, domestic workers, and employees of non-profit organizations. The NFP report causes one of the biggest price movements consistently compared to any news ad. As a result, many analysts, traders, and fund investors and speculators predict the jobs number and the directional movement that will be caused by. So it is really important, and now I'm going to give you some tips on trading on the NFP day. NFP is usually released on the first Friday of each month, and the release will cause intense or increased volatility. Non-USD currency pairs will also experience increased volatility and widening of spreads. Trading at the time of the release is subject to intense and sharp volatility, so it's important to trade with caution and the right kind or amount of leverage. Now let's talk about interest rate decisions and monetary policy statements. The biggest factor affecting the FX market right now is the interest rate changes made by 8 of the major central banks. Not just the FX market, but also major indices and stocks. You can see that every time, let's say the Federal Reserve of America increases interest rates, you will see intense volatility on, let's say the Dow Jones may lose 300 points, it may lose 600 points, it also may lose up to 1,000 points depending on the monetary policy statement at the time or the rate of the hike. So therefore, it has a particularly relevant and interlinked effect to the stock market and the FX market as well. The main economic events and data in the US right now are the interest rates, the Federal Reserve decisions that we wait for every month to know the direction of particular assets, and the NFP employment change, which is also a reflection of the number of employment in the US and how much workers are available in the economy, and also the unemployment rate that also, if it increases, it means that interest rates are negatively affecting the employment sector, and so far and so forth. So everything is interlinked, and that's why these are super important data factors from the calendar. Also, Jerome Powell's speeches and what he says or what he signals about specific market conditions. Is he going to be hawkish or dovish? Depending on what kind of statement he says, it's basically taken as a signal and then implemented in a trade. The Eurozone interest rates, Purchasing Managers Index, President of the European Central Bank, Christine Lagarde's speeches, UK interest rates, GDP, PMIs, Consumer Price Index as well. In Japan, we also have leading indicators and the Bank of Japan decisions, the trade balance and the GDP. And Japan, just like the USD/JPY, has some special indicator about the trade balance, and that's why it's important to follow as well. From Canada, we have the change in employment rates, the Bank of Canada decisions, and that will also correlate with oil prices. The USD CAD is also, and the AUD USD are one of those, or two of those currencies that are affected by commodity countries like Canada and Australia. Australia interest rates, GDP, employment rate, and trade balance are also key important indicators. New Zealand as well. Also, in addition to prices of dairy products that will also interfere with the price of the entity pair, the kiwi, or their stock market as well. So now you are good to go with fundamental analysis. Keep your eyes open on the calendar because it really does have a significant impact on the pair's direction or the stock market direction of or the product that you are trading.